August 20th, 2024. Today we had a parabolic wedge on the open, a reversal down, and then a midday reversal back up, and we ended up closing around the midpoint of the day. Obviously, on trading range days, there we go. On trading range days, it's really common to test the open of the day towards the end of the day. It's one of the most common magnets. So whenever you're in a trading range day like this, you should highlight the middle of the day and realize that we're probably going to try and test that around the end of the day. You can see we basically came one tick away from closing at the midpoint of the day. So that's something to pay attention to. The reversal down ended up testing the midpoint of this entire rally from yesterday. So that's where we ended up getting this midday reversal, was at that support point. Sorry, let me just get this the way I want it. All right, bar one, a bull bar, but a small tail on the top. It's still okay, to be long. We're still always in long from these, but you have to ask yourself, how much higher are we going? Keep in mind, when the prior day was a small pullback bull trend day, like yesterday was, the next day has a 75% chance of 2 hours of sideways to down trading starting by the end of the second hour. There's a 50% chance that you're going to get some sort of follow through buying on the open, which would be what we got here. So this is part of that 50% chance. There's only a 25% chance, though, that we end up getting some sort of small pullback bull trend day. So any of these buys early in the day were probably better scalps than they were swings. You can see bar one is unable to close above yesterday's high. So slightly less bullish for the bulls. Again, still good for the bulls, but not as good as it could be. Really interesting. I'm not really sure the last time I saw this, but it's been a while since we basically opened, or I guess we didn't, not at the exact, but one tick away from yesterday's close. So there was basically no gap. Bar two, a doji bar. So disappointing follow through if you bought one, getting a doji bar. Still always in long, and we're probably going at least a little bit higher. How much higher? I don't know. Maybe some sort of measure move up, leg one, pull back. And then, you could argue that the leg two started there, somewhere down here. You could argue the leg one technically started here. So you could say leg one, pull back, leg two, something like that. But I think it was reasonable to look to take profits somewhere up in that area. Like I said, I think if you're buying here, you have to understand that you're probably going to end up needing to scalp. Disappointment on bar two. So a doji bar. Bar three, another bull bar closing near its high. So 1 and 3 are bull bars closing near their highs, with 2 being a pause bar. But you have to recognize that if bar 4 is a pause bar, so 2 is a pause bar, because it's not a big bull bar closing near its high. And if bar 4 is a pause bar, then that means that whatever rally we get after that might end up being some sort of third leg up, and it could be 1, pause, 2, pause, 3 for a parabolic wedge on the open. When you get a parabolic wedge on the open, obviously wedges in general, we try to get to measure moves of wedges. And when you get a parabolic wedge on the open, the bulls are hoping we go sideways for 2 legs sideways to down, and then we rally. And you can see today, instead of getting a measure move up of the parabolic wedge, in general, whenever you get a spike, well, we got a measure move down. First of all, I'll just finish my thought. But in general, whenever you get a spike on the open, the market's going to try and create some sort of measured move of said spike. So you can see we had yesterday's midpoint over here, and we had this measured move down right here. So there was a lot of reasons to be some profit taking in here. So bar 3, a bull bar closing near its high. We have bars 1 and 3 closing near their highs for the pause bar on 2. Yes, we're always in long. We're probably going at least a little bit higher, but if bar 4 does not look like bar 3, to me, I think this might end up being a parabolic wedge. Bar 4, a pause bar. So when I see bar 4, I'm probably all done buying. Some traders will buy, betting on the third leg up, but they'll probably scalp out during bars 5 or bar 6. So reasonable to be long, but you have to realize the upside is probably very limited here. I'm not sure how much higher we're really going to go. Bar 5, another bull bar. So bar 1, and then a pause bar. Bar 3, and then a pause bar. And now we have bar 5. So to me, it's 3 pushes up. We're probably going to start to go sideways pretty soon. 6, I look at this as a climactic bar. It's a climactic breakout attempt above, the bull channel. And again, this whole thing, really, if you look at it, so you remember how yesterday, if you listened to yesterday, I was talking about when you break out below a little channel like this, you expect to test to the other side. When you break out above a channel, you expect a test at the other side of the channel. If you look, we've pretty much been in a bull channel for a couple of days, roughly this. And we broke out, or tried to break out above the high, ends up failing. And you can see, you could argue the low is down here. You could draw a lot of different lows, but I would use this as the most recent low. But that would increase the chances that we're going to get a failed breakout above the high and a test down. Remember, the yesterday's close, these bars are extremely climactic, and they're probably the end of the trend. 60% chance that that's the end of the trend, but also 60% chance of us getting one more leg sideways to up. So I think that the rally on the open was that one more leg up. So 6, we have 2 pause bars. We have a parabolic wedge on the open, and we have a breakout above on bar 6. So pretty climactic. I think a lot of traders are probably going to look to take profits here. 7 is a disappointment bar. Had 7 closed on its low, it was a credible short for the high of the day. And if 8 had been an inside bar or something like that, if we had gotten any bear bar closing near its low in this area, I think it was a really credible sell. But unfortunately, bears just never quite got what they wanted, and then we ended up selling off in a pretty climactic way. Remember, when you have a buy the close scenario like this, 60% chance that at some point during the day you're going to get back here. 80% chance that you're going to be able to buy above a bull bar closing near its high and get out of your trade around break even. So the bulls who bought above bar 6 close, maybe they bought more on, you could have bought more on 29, but it made more sense to scalp out in this area since you were buying the midpoint of the trading range. But 44 makes a lot of sense as well. You can see we rallied up into that area, and that's part of why we ended up stalling here. It's also the top, we have this channel, but this is a really spike, and then this isn't as impressive, so possibly the top of the channel here. 7, a bear bar, but a tail on the bottom. It's okay that it traded below 6, but I think 7 needed to close on its low to be a credible sell, and instead it did not. So that's part of why we see a lack of urgency on bar 7. Bears are hoping for a big bear bar closing near its low, and they got the big bear bar, but it's not quite closing on its low. And so it's not really worth selling. The bulls who bought below 6 will probably be able to scale in lower and make money. We should be getting a second leg up from bars 1 through 6, but I'm not sure when it's going to come. 8, an inside bar, a tail on the top and a tail on the bottom. Are we going a lot lower? I don't think we're going a lot lower. Or sorry, we're going a lot higher. I don't think we're going a lot higher. I think the best case scenario for the bulls right now is we test back up to around the bar 6 high. Bar 7 to me says that this is probably more of a trading range than a trend. And you probably were already pretty suspicious that this was a trading range instead of a trend because of the parabolic wedge. So for me, I don't really want to buy up here. I'd rather be looking to take profits. And then you can see an inside bar, a low 1 short on bar 8. Do you sell below 8? I probably would not. It is a bear bar, it is a bull bar. So that's really not what you want. Had we gotten, again, an inside bar, let's say we got something like bar 53 today, instead of bar 8. And so let's say bar 8 looked like bar 53 today. That would be a credible low 1 sell. I'm just personally not going to sell below a bull bar. So I'll just let it go without me. But the bears are hoping it's a low 1 short in their bear trend. So they're hoping the bear trend started on 7, or at least the trading range started on 7, and they're going to be able to sell and scale in. And the bulls are hoping that this is a credible high 1 and that we're going to rally and start the bull channel. So they want spike and channel. Spike up to bar 6, pull back 7, and now they want a channel. Not really all that likely that that's going to happen, though. I think we're probably going to end up testing back down. And then a big surprise bar on bar 9. This is bulls giving up. Give up bars are really important, especially in trading ranges. You can see they were kind of all over the place today. But 9, a huge bear bar, but a tail on the bottom. You can see that the bulls stepped in around yesterday's close and at the moving average and below bar 1. Obviously, bulls are going to buy below bar 1 because we have a strong spike, bars 1 through 6. Although it was a parabolic wedge, it's still a credible bull spike. So there's going to be traders looking to buy down here on the initial reversal down. So, like I was mentioning, buyers at the moving average, buyers stepping in below bar 1. Some bears still sell the close of bar 9. Yes, it's a climactic bar. If it had closed on its low, maybe it would be a bit better, but 9 is probably more of a sell the close bar than a sell below bar. Because when you have these tails, you sell the close, betting it's going to trigger below the bar. 9 is on its own a big enough surprise that we're going to get at least a second leg sideways to down. We might end up going a pretty decent amount lower. Maybe a measured move of the bar, somewhere down here. 10, another bear bar. So you can see some bears did, in fact, sell the close of 9. Now we have consecutive bear bars, 9, 10. 9 was enough to make the market always in short. We were probably contextually always in short, as 9 was forming, if not probably not quite during 7 because of 8, but as 9 was forming for sure, the context flipped to always in short. But the bars were probably still somewhat always long because we had a relatively strong spike up to bar 6, regardless of the fact that it was climactic. So I think once bar 9 closed, we were definitely always in short, and especially once bar 10 closed, we're always in short. However, it's definitely a bit climactic. It's big up, big down. But again, this spike, they covered, bar 9 covered the entire range that bars 1 through 5 covered on the way up. So it's really not all that optimal for the bulls here. 11, another bear bar, but you can see we're slowing down. So 9, a big bear bar with the tail, 10, a smaller bear bar with the tail, and 11, basically a doji bar. So yes, is it 3 straight bear bars? Yes. Is it 3 straight bear closes? Yes. But are we going a lot lower from here? I don't know, maybe not. And if we do go a lot lower, you have to keep in mind we're probably going to get a pullback first. 12, an outside up bar. So triggers the high 1 above the bar 11, the bar 11 doji, but really not that good. No one wants to buy above. Obviously, there's going to be sellers above 11 after the spike 9, 10, 11. So outside up bar 12, but a big tail on the top. Really not as ideal as it could be. An inside bar on 13. So we have an IOI pattern. 11 is inside of 12 and 13 is inside of 12. So this is a breakout mode pattern. It's potentially a final flag for the bears. If we do break out below it, it's possible that we come back into that area. And then we get 13, a huge bear bar closing near its low. Sorry, we get 14, a huge bear bar closing near its low. Can you sell below 14? Yeah. The thing you have to keep in mind is that it's possibly a parabolic wedge. 1, pullback, 2, pullback, 3. So if you're selling 14, you might be selling a third push in a parabolic wedge. That's possible. However, what is also possible is sometimes when the market gets overbought like this, you'll get a big outside down day. And if you're selling below 14, your premise is probably that we're going to get that big outside down day and try to get somewhere down here. How likely is it? I don't know. At the close of bar 14, maybe 40%. The next couple bars will be really important, but you can take the trade because you're risking 10, 11 points. You'll just put your stop above the bar 12 high. If you shorted down here and we get above here, your premise is no longer valid. So I think, it's if you're taking the short below 14 and your stop's going to be up here, you're probably looking to get somewhere down here. You're looking for basically a collapse, which the context kind of supports, to be honest, on the day because we're so overbought. So I wouldn't be surprised if we did get another 30 to 40 points to the downside and that your risk reward is basically 4 to 1 on what is most likely around a 40% chance of happening. So it's credible to take the short and see what happens. However, the obvious problem is this could just be a trading range open and we have a possible parabolic wedge here. So you might be selling a third leg down in a trading range instead of a strong breakout. 15, a tail on the top of 15. Obviously, it did not overlap quite with the 12 low, so it does keep that gap open. And 15 does end up being a bear bar closing near its low, which is good for the bears, meaning we're probably going to get another leg sideways to down, even if we do pull back. However, 15 has a large tail and overlaps 14 a lot. If I'm selling, below 14, I want to see 15 look a lot like 14. Granted, it's still okay enough that a lot of bears will stay short. But some bears, what they did was they sold below 14, maybe scaled in higher during 15. And then they got 15 closed and they were thinking, well, I really wanted to see 15 be a big bear bar closing near its low, looking something like 14. And instead, they got this bar with a lot of overlap. I personally think it's definitely okay to stay short if you are short, but it's still that starts to support the argument that this might be a parabolic wedge. And then what the bears do is they buy back shorts, and that's what's causing the huge rally on bar 16. So 16, a bull bar, but a tail on the top. It triggered above bar 15. It's a big bar, big risk. So it's not really worth buying above 16 unless you're using a wide stop. This is kind of the problem, with traders. You can't buy above 16 and put a stop below 15. It doesn't make any sense. If you're buying above 16, you have to use a pretty wide stop and probably scale in and buy more below 15 or below the 15 low, if anything. So parabolic wedge, bar 16. Do you buy above 16? Like I said, I probably would not. It's a big bar with big risk. Traders are probably going to be more interested in buying a pullback of the bar than anything else. 17, a bull bar, but a tail on the top and a tail on the bottom. And yes, it's follow through for the bulls who bought above 16, but it doesn't even close above the bar 16 high. So how good is it really? It's probably not all that great. I don't think we're going to get that much higher. You can see we're basically right at the moving average, but getting disappointing follow through here. So I don't know. The reality is the bears who sold the close of 15 or 14 did a relatively reasonable thing. So we're probably going to end up testing back into that area. And 13, 14, and 15 were pretty strong. So we might have to get a lower high. So as big and strong as 14 or as 16 looks, it's probably not really all that good. And 17 is not the follow through you wanted if you bought above 16. If you bought above 16, you want another bar that looked like 16 and maybe get some sort of vacuum test up into this area. But instead, you got this. 18, a bear bar. It triggers the low one short below 17. There's probably buyers not too far below 17, scaling in lower. We might test back to the bar 15 close. You can see on 18. So low one short 17, but there's going to be buyers below 17 scaling in lower, going to make money. So not really all that great for the bears. The bulls are hoping they still see the low one in the quote unquote bear trend, but they're hoping it's more of a channel. Now we're going to convert into a trading range really soon. The reality is at this point, the odds are not all that good for anybody. The bears see the parabolic wedge and they are hoping 18 is the start of a reversal down and we get a breakout below the parabolic wedge. The bulls don't really care if we try to break out below the parabolic wedge, so long as we don't get a strong breakout successfully below and we reverse back up into the range. 19, a doji bar. I just want to look at something. Okay. 19, a doji bar. It's an inside bar. The bulls are hoping that it's a breakout pullback, and this is their high one from bars 16 and 17. So they have a high one, but a bear doji bar. So I'm not all that eager to buy it. We're probably getting back up to the bar 17 close at some point today, but it doesn't necessarily have to be all that soon. The bears, they see follow through, so they're hoping 19 is follow through from the big bar on 18, and that we continue lower and get a breakup below the parabolic wedge. So basically, the question you should be asking yourself right now is the bottom of the parabolic wedge is the bar 15 low. So when we get down to that point, are we going to get a strong breakout below, or are we going to get a reversal back up? 20. There's sellers above during 19, so not really all that good. Probably sellers above the bad high one, scaling in higher. And the bulls, they're hoping to get more follow through here. They want 21 to be a big bull bar closing near its high. Again, the thing you're looking for here is kind of a give up bar. You're looking for the bulls, either the bulls to give up and we collapse to the downside, or you're looking for the bears to give up and we get a bounce to the upside like we ended up getting on bars 29 and 30. So 21, an inside bar. It's an IOI pattern, bear bar closing near its low. It's a low one short for the bears, but I don't really want to be selling a low one short in this area. It seems like we're going to be a little bit more sideways. To me, this is a tight trading range, and I think we're always in short, so you can be short. Probably stop above 18. It's more logical to put a stop above the bar 12 high since we just got the most recent higher low, and we haven't broken lower high, and we have not broken below the bar 15 low yet. So it's credible to just put a stop above 12. However, the reality is if we get above bar 17, your premise that there's some sort of bear trend or strong bear channel here is not really that valid. So if you are short, you have to keep that in mind. 22, disappointment, buyers below 21. And you can see we rallied back to around the bar, the close of bar 20, but really we're just going sideways here. 22, bulls want some sort of high two, but I'm not really sure it's all that good. There's probably sellers above 21 if we go above 21, and there's probably sellers above 22 since it's not a bull bar closing near a high. You will notice that every time we touch the moving average, basically around bar 13, bar 18, and then eventually on bar 23, we basically ended up pulling back. So traders are selling the moving average, which is good for the bears. Sometimes the bulls will start to try to get reversals up like they're getting here, and then they cannot get a close above the moving average, and they basically just end up giving up and you get a collapse to the downside. Obviously, that was not the case here, but that's what the bears were hoping for. As long as they could just continue to keep the market above the moving average, below the moving average, then the bulls would eventually give up and they would start their bear trend. 23, sellers above 22, scaling in higher. Again, just a tight trading range. And then 24, a bear surprise to the downside. The bulls are hoping it's a third push down. So they have this breakout, and then we're getting a wedge pullback, 1, pullback 2, pullback 3. And the bears are hoping it's a strong breakout, and we're going to close below 15 low. You can see it's kind of the same problem as over here, where we don't quite close above that area. And here it was pretty critical for the bears to get a close below the bar 15 low. However, they were unable to do so. And that means the breakout is not quite as strong as it could be. So it would have been a lot stronger for the bears had 24 closed a tick or two lower and closed below the bar 15 low. But instead it was unable to. And so so that adds more credibility to the bulls thinking that this is a wedge breakout pullback, essentially testing below the bar 16 low, where weak bulls will have stops and strong bulls will have limit orders to buy more. And we're getting a reversal back up on bar 25. 25, it's a wedge bottom, wedge double bottom, lower low double bottom. You could probably argue lower low major trend reversal. But remember, if you're getting a lower low major trend reversal, you have to get a higher or a lower You have to get a higher low most of the time before you end up going a lot higher. But I think the bears are going to exit above 25, and 25 is not all that great of a buy because we don't have any closes above the moving average. So I really personally would not want to buy above 25, but I think it's okay to exit shorts. Exiting shorts is probably a lot of what is causing 26, but again, sellers at the moving average. We got through the moving average for the first time today, which is important. You can see the bulls were never even able to get through the moving average earlier in the day, which increased the chances of a sell-off. I'm saying after bar 9. So sorry, bulls were never able to get above the moving average, even during the tail of the bar since a little bit after bar 9. So it's important that the tails on 25 or 26, 27 were able to do so. 27, another tail. So it's a micro double bottom with, sorry, a micro double top with 26. They're hoping for a breakout below the parabolic wedge and now a breakout below the smaller wedge, maybe 18, 22, 25. Basically, they just want to break out below, this range and a measure move down. The bulls are betting that this is a trading range. And to me, at this point, it looks like it probably is a trading range. So not really interested in selling the close of 27. Looks like more of an area where traders might buy back shorts. So if you're shorting down here, you got to be really, really, really quick to get out. It's probably not worth doing. It's better to just wait for the breakout at this point and see if it's strong. 28, a disappointment bar. You can see we traded to a new low again. Now we have another wedge, 15, 24, 27. So lots of ways to draw the wedge, which means increased chance of it working. And we have a failed breakout, a second failed breakout below the parabolic wedge to bar 15. So probably not going much lower. And disappointed bears buy back their shorts, and that's a big piece of what's causing the big bull bar on 29. Now, 29 has a problem as well. It's not able to close above the high of the tight trading range. You can see all of this is a tight trading range. So 29 is unable to close above that high, making this slightly less bullish than it could be. Additionally, just look at it this way. How high up are we going to rally from here? We might go for a bar or two, but do you think this is going to just magically turn into a huge bull trend? Probably not. We're probably going to get a bounce, but it might end up being more of a scalp. So disappointing that it can't close above that high. The bulls who bought above 29 were able to make a little bit over 5 points. You can see basically around the close of bar 30, they made 5 points. So the bulls are hoping this is a wedge of some kind and a reversal up 28, but a bad signal bar, but good follow through on 29, potentially trapping the bears. The bears are hoping this is a vacuum test at the top of the tight trading range, and we're going to start to go sideways. 30 consecutive bull bars, 29, 30. Good for the bulls. On the surface, it looks good for the bulls, and you're thinking to yourself, okay, well, this is a buy the close situation, but it's not. If you think about it, to this point in the day, so right, you can't see, wrong tool, you can't see anything past bar 30. So all you can see is the first 30 bars of the day. Where's the midpoint of the day? The midpoint of the day is right here. So if you're buying above bar 30, you are buying the exact middle tick of the trading range. And if you're buying the exact middle tick of the trading range, you probably want to not be risking very much because the risk reward in trading ranges, the probability in trading ranges is often not as high. Often not as high as it appears to be. So the traders buying above 30, reality is they have really big risk, probably not that much profit potential, and the probability is not as good as it could be. So you have to think about that if you're buying up here. 31, disappointing follow through. So the bulls who bought, if you bought above 30, you're probably not very thrilled with 31. You're probably starting to look for a way to get out. 32, an inside bar, a high one for the bulls, probably sellers not too far above. And where did 33 go to? Just look, if you bought above 30, disappointed 31, 32, you're going to use 33 to exit. Maybe they scaled in a little bit lower, but you're going to use 33 to get out of your longs. So that's exactly what's happening is the traders who bought here and scaled in are using 33 to exit, and that's causing the reversal down. The traders who are buying here are not hopeful. They're very realistic about it. And if they're buying, they know that we're probably going to go sideways. So what they're hoping is that we race straight up. And if we don't race straight up immediately, they know that 29 and 30 is going to get a second leg up. So they're going to use the second leg up to exit their longs. And that's exactly what's happening on 33. And any of the bulls who did not exit, weren't fast enough to exit here, will just dump out of their longs. And that's what's causing 34. So now we have consecutive bear bars. We have a failed breakup to the upside. And 34 bear bar closing near its low. 34 is probably mostly bulls selling out of their longs. So if you're selling below here, you're betting that the bears are going to start selling. I think 34 is a credible sell. And you're betting on a breakout below the low of the day and some sort of measured move down. It's a reasonable swing sell if you're quick to get out. And then you get disappointment 35. So that's probably your cue to just exit the trade. If you sold below 34, well, first off, you know that 33 and 34 is strong enough for a second leg sideways to down and some sort of lower high. So when you get those strong bars, you're probably going to get some sort of lower high. It's true that 29 and 30 might have been strong enough to form a higher low, but I don't think the context really supported the bulls in this overall situation. So disappointment 35, and it's a bull close. The Bears really needed a bear close here. Instead, they would have got a bull close. So first off, you have to imagine there's going to be some buyers at the 28 high. The traders who sold this high, scaled in higher, probably not too happy with how this went. So you know this is probably support right here. The Bears, I think, need one more bar. They need 35 to close pretty strong. Or if it doesn't, they need 36 to close really strong. And I think 35 being a bull bar is really disappointing, which is why traders used 36 to buy back their shorts. 36, a bull bar, but a tail on the top. It's an inside bar. Bulls are hoping this is all just a breakout pullback. 29.30 is your breakout, and now we're getting a pullback. Bears are hoping that 29.30 is a bull trap, and 36 is a pullback for them instead, and there's probably sellers above. I would agree that there's probably sellers above 36, but I don't think at this point the probability of anything is all that great. 37, a doji bar. So the traders are probably more likely to sell above 36, an inside bar with a tail on the moving average. 37, doji, low one short for the Bears, but I'm not taking that. I don't think really many traders will, probably not going that much lower. Buyers below 37, tight trading range, reversal up 38. So once you see 38, you should be thinking tight trading range. So 35, 36, 37, 38. Better just not to touch anything here and see what we get. We might get a second leg down from 33, 34, or 33, 34 could convert into a bear trap, and then we start to get a reversal up. Either way, whatever happens, I'm going to wait for it to happen and then look to trade accordingly. 39, an inside bar, a low one short for the Bears. I still think tight trading range. An outside bar, 40, maybe a midday reversal. The Bulls hoping some sort of trend line break, maybe this, maybe something like this, whatever it is. They're hoping for some sort of trend line break here, and then a higher low major trend reversal. Not very good to me, just tight trading range. And then another outside bar, 41. So we have consecutive outside bars, 40, 41. The Bears need another bear bar closing near its low and to break out below the low of the day to hope for that measured move down that they're still looking for. 42 is a pretty good bar for the Bears. To me, when I see 42, I think we're going at least a little bit lower for at least a scalp. So this is actually something pretty important that happened. So let's say you sold below 42. Let's talk about the trade. And you see bar 43. Are you disappointed with 43? You're probably not overly happy with it. So what some traders will try to do, and why not, right? Because you're hoping for a big bear bar closing near its low, and that this is going to start some sort of measured move down. The big tail on the bottom makes me think there might be more scalpers. If that bar had closed even down here, a point lower, then that's a lot more bearish. But I think the tail on the top was big enough to make traders think it might still be a trading range. So if you're a bear who sold below 42 and you think it might still be a trading range, what's your reflex going to be? It's going to be the scalp. You're thinking to yourself, oh, this is not what I wanted. I probably want to just look for, a way to exit here with some sort of profit. So what's a logical profit target? Well, if you look at the range on the day so far, I guess it was at the low so far on that. The range of the day so far is about 36 points. So if you're thinking about scalping on a 36-point day, what's a logical target for scalping? 5 points. So 5 points is a pretty reasonable amount to scalp out with. So what do the Bears do? Well, they sold below 42, and the market needs to go 5.5 points in order to make 5 points. Since if you sold below 42, you sold one tick below. So that's now 5.25, and the market has to go one tick past your limit order in order to fill it, which is why it's 5.5 points to make a 5-point scalp instead of 5. So the market has to go 5.5 points from that low. If you look, it only went to 5.25 after this. So the Bears, they shorted below 42. They don't like 43, so they put a limit order to get out basically right here. And it only got to right here. So that's called a 21-tick trap. And when we have a 21-tick trap here, what happens is the Bears start buying back their shorts in a panic, and then 44 is a big bull bar closing on its high. And those Bears are thinking, oh no, now I'm trapped in this trade and I'm getting a big bull bar closing near its high against me. I probably got to get out. So what this is all going to do is add fuel to the fire for the Bulls. And now Bulls think, when you see 44, we had a couple of chances to go down. I think we had a valid attempt to go down on bar 14. We had a valid attempt to go down kind of 34. And definitely on 42, we've had a couple of valid chances to the downside. And now we're just getting disappointment again. So I think the Bulls are probably going to take a chance. Or the Bulls probably basically try to get a rally here. Granted, 44 is a pretty strong a pretty strong bar, but it's really large and it's following 3 straight bear bars. So our bull's going to buy directly above this. Some will, and they'll just put a stop below here and not worry about it. But other traders will look to buy more of a 50% pullback, which you can see we got to on bar 50. So it ended up being a 3-push pullback, essentially. 1, pullback 2, pullback 3. Or you could argue, since we never traded below or above any of these bars, this is the first push down. 1, pullback 2. So maybe some sort of 2-legged move like that. But either way, if you're buying above 44, you have to realize we're not going to go straight up. So your best course of action is probably just to take the buy, put a stop below, and go for some sort of points. It's more of a swing trade, right? So you probably want to make 10 points, which would lead you up into this area, which I think this is a completely fine area to scalp out in. Or you could just get out below 60, 61, and you get out with roughly the same amount of money. 45, a disappointing bar for the bulls, but it's relatively expected. If you bought above 44, you knew the market wasn't going to go straight up. The bears see a low 1 short, 42, 41, 42, 43. They hope 44 is a pullback and 45 is a low 1 short, but I think that is very wishful thinking. It's most likely that this is just a pullback for the bulls, breakout pullback, and that we're going to end up getting another leg up at least, probably a couple legs sideways up. I would imagine the bears are about to step aside. For anything, the bears, if anything, are just trying to get some sort of second leg down from this and into an area where they can buy back their shorts. Obviously, selling the 43 close, you would be disappointed with how 44 went. So those traders were just basically trying to get any chance to get out. They probably thought 43 close is close enough, and they just got out with a small loss because of how poorly the follow-through bar was for them if they sold 44. So 45, disappointing. Sorry, if they sold 43 is what I meant to say. So 45, disappointing. 46 tries to rally back up to the bar 44 close. Doesn't quite get there. Probably buyers, like I said, not too far below. You can see buyers below 47. But 47, high 1 buy for the bulls. Not a great high 1 buy above a bear close. 48, rally, gives the bulls a first. Some bulls will buy above 44 and just hope we rally straight up. And if we don't, they'll look to get out. Maybe they scale in at around 50% of the bull bar. So there are bulls who just took the scale in buy. And some bulls bought here, they scaled in at 50% and are using this to get out. Some bulls just bought 50% and are using this to get out. Maybe some bulls bought here and didn't scale in and are using this to get out. But either way, you can see some bulls initially sold on 48, and we might get a second leg sideways down. 49, an inside bar for the bears, some sort of double top bear flag with 45. They're hoping for a measured move down. But again, I'm not really interested in selling down here. 50, a bear bar, but obviously when we started to get back to the bar 43 close, bears bought back their shorts, and that caused the rally on the bar 50 low. 51, a bull bar, but a tail on the top. But I think this is what the bulls were looking for once you get 51. You were just looking for the market to go sideways for 5 to 7 bars, probably more like 5 bars, but basically the market to go sideways for a couple of legs and then get a reversal up. And that's exactly what's happened on 50, 51. 52, consecutive bull bars. So good for the bulls. We're probably going at least a little bit higher. And you can notice that the bears who sold above bar 50 and were looking to scale in, they were not let out on 52. So we might have some trap bears. 53, a low 1 short for the bears, or you could argue it's a wedge. So 44, 48, and 53. And some bears might try to sell the wedge for a swing down, but not worth doing. I don't think we're going down. I think we're going up. Disappointment, 54, not surprising. And then outside up, rally, 55. 55 is a breakout above the wedge. So you could argue the wedge is here. And you might be trying to get some sort of measure move up into this area. That's probably reasonable. Again, the bulls who bought above here did a smart thing. So once you start to rally, it's sensible to think they're going to make 10 points. And the low of bar 32 is going to be a magnet as well. And you have the 50% mark between this close and this high, which we should probably rally to as well. 56, consecutive bull bars, tail on the top. 57, another follow-through bar, really climactic, headed up into that 10 points area where traders will probably end up getting out. 58, another bull bar. These, it's technically by the close, 57, 58, but you're in a trading range. So by the close up here probably means more of take profits. The buys were lower, like 44 and 54 or 55. You're not really buying up here. You're probably taking profits. So 59, another bull bar. So we have 5 straight bull bars. And so you're thinking to yourself, it's got to be by the close, spike in channel. No, you're buying basically towards the middle of a trading range. So it's really not worth it. It's possibly a wedge with these highs. Something like that, 3 pushes up. So traders end up taking profits, and that's what's going to cause, let me get rid of this. Traders take profits, and that's what's going to cause bar 60, a bear bar closing relatively near its low. If you sell below bar 60, you probably should wait for a second entry because we still did have a lot of strong bull bars, but I think the inside bar low one short closing near its low on 61 would be a credible short with a stop probably above bar 59 high. What are you looking for if you sell that? I don't know. Maybe, get back into one of these gaps somewhere down here. Maybe that one, maybe this one, something like that. Probably just look for some number of points, maybe 5 points. I don't know if they made 10. Let's see. Whoops. Yeah, they didn't make 10. So maybe something, I don't know, maybe 5 points, or maybe just hold and get out above 73. That's probably reasonable too. So 62, disappointing follow through, but Bears just think it's a pullback. So 60, 61, break or downside attempt, breakout attempt, and then 62, pullback. The Bears or the Bulls are hoping that this is the start of a second leg up, so a spike and channel bull trend, but I don't think that's likely. This is a trading range day. 63, the bear bar, but the tail on the top, the tail on top is fine, but it's not quite closing below the bar 62 low. So to me, I would just, you can sell it, but I think the sell was better below 61. Some traders will sell on a limit order at the 61 low after they see 63. And they get filled on 64. And that's part of the reason why it started to sell off. Upside down 65, obviously sellers above 64, a bad high one buy for the bulls after a tight channel down. So sellers above 64, outside down 65, but a lot of the traders will scalp out. 66, an inside bar, a high one buy, probably sellers above still, but a second entry for the bulls. So sorry, high two buy, second entry for the bulls. Disappointment 67. Bear bar closing near its low 68. It basically just ends up in a tight micro channel down. And then you get the best looking bear bar 72, trying to get a climactic breakup below the channel, and it ends up failing. Reversal up 73, testing the other side of its range. Probably just get out. And then obviously we end up closing around the midpoint of the day. So pretty normal trading range day today. So for stop orders, well, we had a parabolic wedge on the open, so you could have bought above 103, but you probably need to be scalping if you're doing that. It's hard to get in on the sell off. Had 7 closed on its low, I was going to sell. Had 8 been a bear bar, I was going to sell, and just nothing. It didn't work out that way. So, you could sell the close of 9, but not as ideal. You could probably sell below 4. You could sell below 14, but you have to realize possible parabolic wedge. You're taking a chance it's a bear trend day and not a trading range day, so not very high probability. And the risk is reasonably big, but I still think it's okay to do because your reward is really, really, really large as well. But I think 16 makes your premise a lot less valid, so a lot of traders will use the move back down to try and get out around break even. I would not do anything else until 29. You can buy 29, but I don't know. The problem with buying 29 is that it's a lot of times it will get reasonably good follow through like 30, and then you'll sit there and think, okay, this trade's going to go a little bit, but it's probably not because you wouldn't want to buy the close of 30. So when you're taking trades like 29, the problem is you end up seeing 30 and you think to yourself, well, I probably got to get out, but I don't know if I have, my profit target. So if you're buying above 29, probably just scalp for 5 points. Don't be too fooled by 30. You can probably sell 34, but, I don't know, hard to sit through the tight trading range. It just ends up being a 3-push pullback, but hard to do. You can sell 42 for sure, but disappointment 43. Traders buy back shorts 44, bull bar closing near its high. Bulls can buy 44, sit through the pullbacks, or if you want to wait, you can just buy above 55, buy the close 56, 57, 58, but it's getting really, really, really high in the range to be doing that. And then you could probably sell below 61, 63, and that would be that. On the daily chart, we have a bear bar. So we have a bear bar, good for the bears. But the reality is this is such a tight bull micro channel without any bar trading below the prior bar that once we do trade below a prior bar, there's going to be buyers in a second leg up. Since this is a bear doji bar, it's probably towards the end of the buying. So I'm not sure how much higher we're going. Obviously, the bulls did a really good job with this, and it's going to get a second leg up. We're probably going to the new high. Not this week, but I don't know, next month sometime maybe. Depends how the pullback looks. But if you look at a weekly chart, really strong pair of bull bars, this is going to get a second leg up. So we're probably going to get up into this area. I don't think we'll go straight up, but we are obviously going to end up getting up in there. The real question is, if we're going to start to pull back soon, is it going to be a bull close? So we're only a bull close right now by about 50 points. And if we're going to start to pull back soon, because we're a little overextended on the daily chart, we're probably going to try and pull back into the open of the month area, which is around right here. So I think, over the next couple of days, we're probably going to drift down into this area, and there's going to be a fight over the open of the month on the daily chart because the bulls obviously want a bull close and a good looking bull reversal bar, and the bears want a disappointing doji bar and a bad high one buy. All right.